Hey folks, welcome to another video by Stock Trades. My name is Matt, and today we are going to take another look at some dividend stocks. But this time we are going to focus on some companies that have recently announced a dividend raise. Before we get to that, just a reminder, please subscribe to our channel, like the video, and comment below. And you'll be entered into a draw, our monthly draw, to win one of Stock Trade Premium's membership. So congrats to our winner last time. We did draw a winner for January, and now we're in February already. So please like, subscribe, and comment below to be eligible. And with that, we're going to get to our 3 stocks that have raised dividends right after this. At this time of the year, it's actually a very busy time for Canadian dividend stocks because between mid to end January and the end of February, there are typically a ton of companies that announce their annual dividend raise. As a reminder, we have 2 different lists, if you will, in Canada. One, which is the Canadian Dividend All-Star list, which is maintained by Dividend Growth and Retirement, doing an excellent job, and one that is called the Canadian Dividend Aristocrat list. Both have similar concepts, as we've discussed many times before, but there are slight differences. Bottom line, however, if a company has raised the dividend for 5 consecutive years, they would be considered for inclusion in these 2 lists. So the first company we're going to be talking about today is CN Rail, CNR on the TSX. CN Rail is the largest railway stock in the country. It's actually one of the biggest industrial stocks, and many Canadians own this stock as a fundamental piece to their portfolio. So it's not surprising that CN Rail came out with their annual dividend raise over the past couple weeks. CN Rail has actually been under a little bit of a pressure recently. A number of things have happened since before COVID. It dealt with a strike, it dealt with the Wet'suwet'en rail blockades, and then it dealt with COVID. Not only that, the company had a failed takeover bid for Kansas City Southern, and 2 of its majority shareholders entered into a proxy battle with it in terms of replacing current and outgoing president JJ Douet. So it's been a very interesting time for CN Rail, but despite all this, despite all that noise, the company has still delivered returns of approximately 50% over the past 3 years. So this is a true fundamental stock for investors, and it has performed exceptionally well despite all those headwinds that all happened within the past 3 years. CN Rail delivered exceptional 4th quarter results in which it beat on both the top and bottom lines. Importantly, the company's operating ratio, which is a key industry metric, rose by 3.5 points to 57.9%. This was a big sore point for those 2 majority shareholders that I mentioned previously, TCI Group being the main headliner there. They were critical of CN Rail's operating ratio versus peers such as CP Rail. However, as mentioned, the company has been faced with headwind after headwind, which has been impacting this operating ratio. So it was nice to see a nice jump in this area, and it also delivered record free cash flow of approximately $3.3 billion, which is fantastic, and enabled the company to announce their annual dividend raise of approximately 19%. Which is higher than average. It's higher than average because it delivered record cash flows, and the company also announced its 2022 outlook, in which it now expects to increase earnings per share by approximately 20% and for cash flow to grow to $4 billion in fiscal 2022. Taking all that into account, the company's forward payout ratios against earnings and cash flows are approximately 41% and 73% respectively. This is really good. The dividend is well covered, and at 21 years and counting, CN Rail is tied for the 10th longest dividend growth streak in Canada. So we very much like the company. We think it's one of the best fundamental stocks to own in the country. It just continues to deliver regardless of the situation, and it's one that we're comfortable holding, and it's really one of those rare stocks that you can buy at any point in time. Next on our list, and we're going to do this one pretty quickly because Dan covered a big portion of it last week, which is BCE. As we all know, BCE is the largest telecom in the country. If you want to go into the several details about BCE, Dan does a good job of recapping that last week. So I'm not going to go into some of those details, including why it only has a 13-year dividend growth streak. Curious why? Go check out Dan's video. What I wanted to speak about is the company's dividend growth rate. So right now, BCE has averaged pretty much like clockwork 5% annually, which historically can't complain about 5% annually, right? I mean, it's consistent, it's reliable, the dividend is well covered, and there are no issues. However, one of the things to take into account when looking at dividend growth stocks is whether or not the dividend growth rate is outpacing inflation. And this is where that 5% annual raise that investors have typically gotten from BCE, which historically, no problem, is now perhaps not all that attractive. Why do I say that? Because inflation is on the rise. Since July, inflation has been on a steady uptick. And right now, the last few readings of inflation have been about 4% to 4.8% since December. So November, December, January have all been in the 4% to 4.8% range. January is expected to come in at 4.8% as well. So now what we're seeing is BCE's dividend growth rate is now only matching the pace of inflation. So this is something to keep an eye on, because eventually, if the pace of inflation continues upwards, if BCE only raises the dividend by 5%, now that money that you are bringing in, that income that you're bringing in annually from an investment such as BCE, is no longer outpacing inflation. So that means that the purchasing power is no longer going to be the same. That purchasing power that you're going to get from BCE's dividend, assuming you don't add any more shares or anything like that, will actually decrease year over year. So it's kind of interesting to note. It's less relevant for those who aren't in retirement or those who don't rely on the income on a day-to-day basis. But for those who rely on BCE income, it's worth keeping an eye on. It's worth looking at. Not saying it's a danger or a reason to avoid the stock by any stretch of the means. It hasn't been an issue over the past 20 years. Right now, it's okay. It's still meeting inflation. But as soon as it doesn't, that is where the concerns come in. So just keep an eye on it. Personally, I prefer TELUS because it has a higher growth rate than BCE, and it also has a higher dividend growth rate than BCE. So that's one of the reasons why I prefer TELUS. But BCE is not a bad stock. It's more like a bond, a high yield bond. Let's consider BCE a high yield bond. That's pretty much what it's equal to at this point in time, except you get more income out of it than you would a bond. So overall, it's still a really good investment. It's just a different take, something to look at, something to consider when investing in BCE. So with that, the last stock on our list is Imperial Oil. Now, Dan briefly touched on Imperial Oil last week when he was talking about XEG, but Imperial Oil is one of the best dividend growth stocks in the energy sector. After COVID-19 hit, a slew of energy companies cut the dividend. That included pipelines, some of the most reliable stocks in the country. Former dividend aristocrats cut their dividend because of COVID. However, Imperial Oil wasn't one of them. Actually, one of the biggest cuts in the industry was Suncor. Previously, there used to be three major oil and gas producers that were considered best in class in terms of dividend growth. That was Suncor, Imperial Oil, and Canadian Natural. While Suncor cut the dividend, so they can no longer be considered part of the big three. Yes, they have since returned the dividend to pre-pandemic levels. However, they still cut, and they kept that cut pretty low, and it's impacted their share price. Whereas CNQ and Imperial Oil have maintained their dividend. Not only that, the timing of their dividend raises led so that they were able to extend their dividend growth streaks. All three companies, Suncor, Imperial Oil, and Canadian Natural, all raised their dividends in early 2020, right before COVID hit. Then, once COVID hit, Suncor cut, the other two kept their dividend steady. They chose to wait it out and see what happened. And well, we know what happened. The price of oil and gas shot upwards, and they were not only able to maintain their dividend, but they delivered again in 2021 with their annual raise. So Imperial Oil is the first out of the blocks in 2022, and they announced a 26% raise to the dividend. An outstanding raise. It's actually much higher than their historical average, which is in the mid-teens, and it really establishes itself as one of the premier dividend growth stocks in the country. You may not know, but Imperial Oil has a 27-year dividend growth streak, 28 if you include this year, and this is tied for the 7th best dividend growth streak in the country. Not only that, it is the longest dividend growth streak among all energy companies. That's right, longer than CNQ, longer than Enbridge, and longer than TC Energy, which, worth noting, are the only 4 Canadian dividend aristocrats or all-stars remaining in the energy sector after the COVID washout. So that's a kind of an interesting fact, is that there's now only 4 energy companies that are considered Canadian dividend all-stars or aristocrats. It's also worth noting that since the price of oil has skyrocketed and companies like Imperial Oil are generating considerable cash flow, they are not only increasing the dividend, but they're also returning cash to shareholders in other means. For example, last quarter, Imperial Oil purchased for cancellation up to approximately 17 million shares, which accounts for 2.5% of its float. And that was just in one quarter. You can expect the company to continue repurchasing shares and accelerating its buyback program so long as the price of oil is at these levels. Why? Because it's generating record free cash flows. In fact, the company's chemicals and upstream segment posted their best quarter over the past 30 years. So Imperial Oil is pretty much firing on all cylinders right now. So expect the company to continue rewarding shareholders with additional buybacks and nice dividend raises, so long as the price of oil remains steady. I would say anywhere above $70 to $80 WTI, and Imperial Oil is just going to be flush with cash. And right now, the environment points to that being sustainable at least over the short to medium term. Will the price of oil and gas stay at these levels over the long term? It's anyone's guess. There are so many things that can happen. One thing that investors can bank on is Imperial Oil. They have a 27-year dividend growth streak. So they've raised over all the highs and lows experienced over the past, couple decades. They've managed to maintain it, which is a sign of excellent management, and investors can be comfortable knowing that they will continue to raise a dividend regardless of the environment. Now, obviously something can happen, but if you're looking for the most steady dividend growth payers in the oil and gas industry, there's really only two: Imperial Oil and Canadian Natural. Those are your choices. Those are the only two that have proven capable to not only maintain, but raise the dividend regardless of the current economic or environment condition. So those are the three stocks we want to talk about today: CN Rail, Imperial Oil, and BCE. We will be bringing to you many other stocks over the course of the next couple of weeks, simply because we are expecting many other dividend raises to come over the course of February. So we're going to talk about some other companies as well. CN Rail, it's really one of the rare stocks where you can buy, set, and forget. While we never recommend that, we always think it's important to keep an eye on your stocks. CN Rail is as consistent as it gets. It has a huge moat. It's one of the largest companies in the country, and it just continues to deliver. BCE is also one of those companies where you can pretty much set and forget. As Dan mentioned last week, it dominates market share with TELUS and Rogers. It has a higher than average yield. It consistently delivers. It's just one hesitation I have is that dividend growth rate. Can it outpace inflation moving forward? It'll be something to watch. It's by no means any reason to avoid the stock, but it is, let's call it a yellow flag, and something that investors may want to monitor. And lastly, we have Imperial Oil. While I'm not bullish on the long-term prospects of oil and gas, simply because it is a very cyclical nature, this is one that you're going to have to monitor more than most. That being said, it is one of the safest dividend growth stocks in the country. I mean, it does have the 7th longest streak, and it has proven capable. So there's no reason not to have faith in management, considering how well they've done in this very cyclical environment. So let us know, do you own any of these companies? Personally, I only own CN Rail. I don't own BCE. I actually own TELUS instead. And I don't own Imperial Oil. Actually, in fact, I'm stuck with Suncor. I'm not willing to get rid of it. It was a three-legged horse. At one point, Suncor was outperforming the other two for the longest period of time. And then when that dividend cut happened, it just took all the winds out of Suncor sails. I'm not willing to part with it just yet. It is one that I'm looking to exit, to be honest with you. Going to perhaps move to something like XEG, as Dan mentioned. For now, I'm just going to keep it. I'm happy they restored the dividend to pre-pandemic levels, but I'm still not comfortable investing in individual oil and gas stocks right now. I think Dan's approach to buying XEG is probably the better one. That being said, if you're going to pick a reliable dividend growth stock in this sector, it's got to be either CNQ or Imperial Oil, in my opinion. As a reminder, if you want to win a membership to Stock Trades Premium, please like our video, subscribe to our channel, and comment below. You have to comment below if you want to be eligible to enter. And with that, we'll talk to you next week.